Silver's definitely come to life. I would say it's really tough because silver can move so fast. So it can outperform short term really in a big way, but it only takes one or two of those red bars on the silver chart and it completely starts underperforming gold right away. So it loves to take the like it'll be dormant and noisy, the chart for silver, and then suddenly it'll take the elevator straight up, a huge 1 or 2 day spike. If you blink, you miss it. And it's the same on the way down. So silver is very, very difficult to time. You really have to hold through the volatility to make sure you don't miss those. I like gold as the kind of more so the outperformer. I think over the long run, it's just more stable. I think it'll do better because it's more of a global play. As you mentioned, if we start to go more so recession-wise and economy slowing, silver definitely has that industrial demand that will come to a grinding halt. And silver just can drop very quickly. So I still like gold. Silver is primed and ready for another nice pop percentage-wise. I actually did some longer-term chart analysis last week, and it actually showed gold had more upside potential in the next 2 months than silver did, which was really weird because silver actually just had a big pop. I think gold over the next month or three, I think could rally to about 4,100 an ounce US dollars. After that, if the market does go into a reset, so based on the price action right now in the stock market and various asset classes and sentiment, I see the stock market stalling out, maybe pushing a little bit higher over the next couple of weeks, but then it's really just going to be very difficult trading. You don't really want to be in the stock market most likely. Gold is going to become the leader. It's probably going to start to run higher to that $4,100. But when the stock market really does start to break down and sell off, maybe several months from now, and it picks up speed and people start talking bearish again, that's when gold will probably pull back. And I think gold could pull back to the low $3,000 range very easily, because what happens is once everybody starts liquidating and they panic and they're selling, most people just, they throw the baby out with the bathwater. They'll throw out a good position. They just want to liquidate everything when everything they own is dropping in value, including real estate, which is a huge chunk of people's wealth. They start to sell everything. And then, of course, liquidation comes in with margin calls. Most people use margin accounts. They're always overextended. And once your positions start to go down, people don't realize it doesn't take much for the market to go down for you to start getting margin calls. And if you don't take action like right away, by the end of the day, the broker will naturally sell whatever position it wants. And it just starts liquidating. So there's a lot of forced liquidation in precious metals during that time. Even when investors are like, no, don't sell it, sell something else, it still gets sold on them. And that's fear. And that's just a liquidation event. That's a reset. We want to wipe the margin, the leverage out of the system that has jacked it up to the levels that it's at. That creates that opportunity down the road.
Gold is gaining momentum and could soon climb to $4,100 per ounce. Market sentiment and technical indicators suggest gold is leading the way as equities lose steam. Stocks may edge slightly higher in the short term, but turbulence looms. As the broader market begins to falter, panic-driven sell-offs could follow. In this scenario, gold may initially thrive until fear takes hold and investors begin to liquidate everything. That's when we could see gold retreat to around $3,000. The coming months are about strategic positioning before the volatility resets leverage across the system.
Silver's definitely come to life. I would say it's really tough because silver can move so fast. So it can outperform short term really in a big way, but it only takes one or two of those red bars on the silver chart and it completely starts underperforming gold right away. So it loves to take the like it'll be dormant and noisy, the chart for silver, and then suddenly it'll take the elevator straight up, a huge 1 or 2 day spike. If you blink, you miss it. And it's the same on the way down. So silver is very, very difficult to time. You really have to hold through the volatility to make sure you don't miss those. I like gold as the kind of more so the outperformer. I think over the long run, it's just more stable. I think it'll do better because it's more of a global play. As you mentioned, if we start to go more so recession-wise and economy slowing, silver definitely has that industrial demand that will come to a grinding halt. And silver just can drop very quickly. So I still like gold. Silver is primed and ready for another nice pop percentage-wise. I actually did some longer-term chart analysis last week, and it actually showed gold had more upside potential in the next 2 months than silver did, which was really weird because silver actually just had a big pop. So it actually just reduced the upside potential. So I like gold for two reasons. It's a global barometer of health. When the whole world gets nervous, gold is firm and stable. And second, the chart, my technical charts are showing gold percentage-wise, actually its next run is bigger than silver. So that'll probably shock people, but that's what the charts are showing.
When markets unravel, panic often leads to irrational decisions. Investors tend to sell everything, good or bad, during mass liquidations. Margin calls accelerate this chaos. Most investors are over-leveraged. When prices fall even slightly, brokers begin selling off assets automatically. Precious metals, despite being long-term safe havens, often get caught in the crossfire. These forced liquidations aren't about fundamentals. They're mechanical reactions to leveraged portfolios. This is the essence of a financial reset. The system purges excessive risk, making room for sustainable recovery. Gold remains a core asset, but volatility is part of the cleansing process.
So oil to me is very bearish. It's been in a long-term downtrend. There was a big recent rally in oil pricing with the bombing and the war stuff that took place, and oil shot higher. But it was a news-driven move. A few days later, it reversed, dropped straight back down, gave back all of those gains that it had, which is typical. That's what happens on a news-driven move. We never trust those. Since then, it has been going sideways in a bear flag formation, which means it's pointing to lower pricing. It's actually showing about $55, $56 a barrel as the next move down. So I'm pretty bearish on it. I think there'll probably be some type of news or catalyst that the economy's slowing or something, and it's going to start a precipitous fall. But overall, the charts are already pointing to that. And this is what a lot of subscribers who follow my work, we follow the charts. We talk about this is where price is going. This is what we're looking for. And then price finally gets there. And a lot of times it'll make that final push to that target, and there'll be some type of news that triggers. And everybody will be like, oh, it's because this news hit. Meanwhile, it's like, no, the chart, we talked about this like 3 weeks ago. This is where the chart said it was going. But everybody seems to blame it on news. They're always like, well, the news is what caused it. I'm like, guys, the chart, the chart is telling us where the momentum and the volume and all that is headed. So that's what I like about technical analysis, is we can see where it's going to go. Usually a piece of news comes out to help that move, but it's not the news that actually does it. It's the charts and the underlying drive of constant selling or buying that's going to drive it to those targets.
Silver is notoriously volatile. It can soar dramatically in days, but crash just as quickly. While silver might outperform in short bursts, it's gold that shows long-term strength. Gold is not only a hedge, but a global sentiment barometer, thriving when fear rises worldwide. Silver, being industrial, suffers during economic slowdowns. Though silver is ready for another pop, chart analysis surprisingly shows greater upside potential for gold over the next couple of months. Stability and global demand make gold a safer long-term bet, especially when economies edge toward recession.
Natural gas has got an interesting chart pattern. It's either putting in a pretty significant top right now, and it's probably going to go back down to the $2 range. Right now it's trading at about $3.35, so a pretty big haircut from where it is. Or it is building a stage one base, and we're probably going to see a rally to like $7.50. So it is in kind of a big pattern. We have to like let it break out, see which way it goes, see if there's some conviction behind it. It's kind of a coil, a spring. You don't know which way it's really going to go. We have to wait for that chart, but we're probably going to see big volatility in natural gas to the upper or the downside. I think getting in it right here, you're really just taking a 50-50 bet. You're better to wait for it to break and start to run in that direction, and then hop on as it's running and make your money and move out, than it is to like get in position right now and then just toss a coin. It's not really the best way to manage risk. You're much better to get in when it's running, and it's like not guaranteed, but you're in that momentum stream and you're catching it when it's running. So the returns are imminent. You don't have to put in months of this sideways noise, and then you can hit some targets and reduce your exposure. So yeah, I'm neutral on natural gas, but there's a big move brewing there for sure.
Oil's recent rally, sparked by geopolitical tension, was short-lived. Price action suggests a bearish continuation, with potential targets as low as $55, $56 per barrel. Technically, oil is forming a bear flag, a classic pattern before major drops. Meanwhile, natural gas is coiling for a major move, but direction is unclear. It could either crash back to 2 or rocket towards 750. This binary setup means caution is crucial. Entering early is gambling. Better to wait for a confirmed breakout. Right now, both energy markets are high-risk zones, best approached with disciplined timing and patience.
Yeah, I don't really follow the commodity uranium. It's kind of a weird one. I think you have to follow contracts. I've tried to look it up before. It's not my thing. I do look at URA, like the uranium stock ETF. That's kind of my gauge. We definitely have had a big run. We actually just traded URA on one of our strategies. We actually have just got out of it, but we had a very nice trade over the last couple of months. I think uranium is getting a little overbought. I think the market is about to have a correction, which means pretty much all stocks and sectors will correct with the stock market. And so I'm not a big fan of it. I feel like it's just like the stock indices. You're buying, the move is done. Now we need to let it take a breather, a little bit of a reset. And then if it starts to go higher again, you can jump back in. But right now you're just kind of overpaying. It's just pure FOMO. The charts don't even look bullish. It's like it's overextended to the upside. You're really just buying a high, in my opinion. So you're best to wait for that. The other one was copper. I think copper hit some new all-time highs. I used to follow copper many years ago, but I don't really anymore. It's kind of was been seen as a global barometer. But we've got tariff stuff going on, which totally skews the pricing for all kinds of stuff. It creates people to bid up the price or sell it off if there's going to be tariffs. And so I don't really look at it as a gauge anymore. I think it's really volatile, and the whole tariff stuff has added a lot of extra volatility to commodities and things like that. So I don't get any insight out of copper myself.
Uranium stocks like the URA ETF recently surged but now appear overextended. As markets correct, these gains could reverse quickly. This is a classic case of FOMO-driven buying. The rally's likely over, and patience is needed before re-entering. As for copper, once a key global indicator, it's been distorted by tariffs and political risk, making it unreliable for macro analysis. Traders should treat it as too noisy for dependable signals. When charts diverge from fundamentals, risk increases. Both uranium and copper may regain relevance later, but for now, their stories seem temporarily concluded.
If we were to go back and look at the 2007 stock market top, say in the S&P 500, and overlay the chart of gold, and we put that with the same time frame right now where we are, the charts actually look almost identical. The way the S&P 500 has moved, almost the exact chart pattern over the last 5 months. Same with gold. And then on top of it, so right now we're in a phase where the stock market is very frothy. We have a lot of signs that a major market top is coming, and gold is the #1 asset class. It's really outperformed everything long term. Everybody seems to want gold. It's the best. It's been the strongest play. And then if we add the chart of the US dollar index to that, the dollar index goes straight down to the lower right corner. It's like the most hated currency, and nobody wants it. It's way down there. Both charts from 2007 at this exact critical turning point, which was just before a major market top, the dollar was all the way down, had crashed. It was the most hated asset. Everybody wanted gold and they wanted stocks. And it's the exact same thing we have right now. So the sentiment is at a huge extreme. I have this thing I call the inbox indicator. We've got thousands of followers and subscribers and comments from social media accounts. We get a real good gauge of what people are saying and thinking. What they say tells you their underlying concern or desire or fear type of thing. And there is no doubt we are at a screaming sentiment level. People are piling into all the growth stocks like ARK ETFs, clean energy. I mean, you name it, all the things that led in 2020 when the whole world piled into stocks, they're all performing the same again. And when everybody goes in one direction and they're really bullish, usually we're going to see a big turnaround. So I think we're very close, again, 2 or 3 months from potentially gold having one more push, and then it's going to top out. I think the dollar is oversold. I think it's going to find a bottom and start to rally. And we tend to see the dollar strengthen when there's an economic downturn. US dollars, or the US is still a powerhouse, and for some reason the US dollar index always screams and rallies higher. When we go into a financial reset, a stock market reset, economic weakness, the dollar tends to shine.
We're at a sentiment extreme. The S&P and gold charts resemble 2007 right before a major top. The dollar, deeply oversold, could soon rebound, especially in a recession as global liquidity tightens. Investors are piling into growth stocks, echoing pre-crash patterns. But smart money is pulling back. Fundamentals failed in past crashes. Now it's all about price action and intermarket flows. Like tides lifting all boats, bull markets lift all assets, but when tides fall, everything sinks. That's why cash is a position. Staying sidelined during chaos is often smarter than betting early. Timing, discipline, and charts, these are the tools for survival.
Like when I first learned trading, I learned about fundamentals. I bought companies that had good earnings. They had either they're undervalued, low PE ratios, and I would learn to trade with the trend. But I'd buy the stock, I'd do covered calls on them, and then we hit the 2000 tech bubble. And even though I was buying some of the strongest, fastest growing companies in the world, those companies' shares still got cut in half, and then they get cut in half again. And I blew up. I lost all the money I made going into the tech bubble. I gave it all back and then more because I lost my initial capital. I completely blew up. That was when I realized fundamental data doesn't really work. You can hold the strongest company in the world and the share price still drops 85, 95%. And I was like, okay, well, there's something wrong with this because I was just taught, find a company growing quarter after quarter that's in an uptrend and you're good to go. So my biggest shift was moving from data around financial situations to just going, okay, I just want to follow price. If it's moving up and it meets the criteria, I want to own it. If it's going down, I don't want anything to do with it. I don't care if it's the strongest company in the world because I've done that and I've lost my shirt with the best companies. So it really comes down to follow price. Price is the only thing that pays as an investor. I don't care what you invest in. When you buy it, you want it to go up. And that is all that matters. So if we can track the price and how strong the underlying price trend of buyers moving in that direction, if there's a tidal wave of people and a big, strong momentum, we want to own it. And I think you and I talked about this last time as I look at the stock market like the ocean. When the ocean tide goes up, what happens to all boats? They all go up. Well, the stock market is the exact same. When we're in a bullish phase, you can throw a dart, pick any sector stock you like, diversify, because on average, they're all going to go up. But when the stock market's going down, the tide's going down, all boats go down. You don't want to be holding stocks. You do not want to be diversified. You just want to get out of stocks and move to a different asset. And as you mentioned, inter-market analysis is what I do. I find out what other asset classes can we move to that will benefit from that. And that'll rise as the stock market goes down. In some cases, like a bear market, we actually will buy an inverse ETF. So as the stock market's plummeting week after week, the ETF just keeps going up in value. So we can benefit no matter what the market does. And a lot of times we sit in cash because there are mixed signals, and we're heavy in cash right now because we've trimmed off our longs as the market's rallied up and hit our targets. And the market is not, it's showing it's ready for some type of correction. There's a lot of risk right now. And it's funny because everybody wants to get in right now, but they don't realize like the risk is really high. So we're just kind of raising capital. And I think learning cash is the second biggest thing. You don't need to be in a position all the time. Sometimes on the sidelines is the best position that you could possibly have in certain market conditions. And we take advantage of that all the time.
Agreed. Chris, how can people reach out to you?
Yeah, the best way would be to go to YouTube, type in The Technical Traders, or you can go to my website, The Technical Traders. I share my charts every day, and you can follow. What I do is I manage my own portfolio. I share it through my newsletter. So really, I share my exact analysis. You see every trade I put on, I share it as a trade alert. I only trade ETFs, and we have about 5 to 12 ETF trades a year, so it's pretty manageable. And we can benefit in all market conditions and really let you sleep better at night and take advantage of these rallies to new highs that nobody thought was going to happen, and most people are missing or on the wrong side. And it's pretty nice when you can catch the market upswings, avoid the downswings, or profit from falling markets, which we did this year. As the markets crashed about 25%, we were able to benefit from that.